Warren Buffett is the top investor of all time. $1,000 investment in his investing company when it first started would be worth nearly $30 million now. Such profits may appear impossible, but how did Buffett achieve them? The explanation is that he knows what most others don't and adheres to a few fundamental concepts that you may apply in your daily life. Continue watching to learn all of them by the end of this video. We search for three things. When we recruit individuals, we look for intellect, initiative, or enthusiasm, and integrity. And if they lack the last, the first two traits can kill you. Since if you acquire someone without integrity, you want them to be lazy and dumb. You don't want to be clever and energetic. So the answer is that investors behave in very human ways, such as getting really enthusiastic during bull markets and looking in the past and saying, I earned money last year. I'm going to make more money this year, but this time I'll borrow. They're always going to their past, and when they see a lot of money being made in the past few years, they plow in and just push more on pricing. When people look in the past and see no money being produced, they just say this is a terrible place to be. So they don't consider what's going on in the underlying business, which is remarkable, but it provides for a great opportunity. Ben Graham taught me to buy things on a quantitative basis, to search around for items that are cheap, and that was in 1949 that they had a huge effect on me. So I went about looking for what I call cigar butts of stocks. And the cigar butt strategy to buying stocks is like walking down the street looking for cigar butts and finding this dreadful looking cigar. You take it up and have your one puff, dump it, but it's cheap, and afterwards you search for a new cigar. That's what I did for years, and it's a mistake because while you can make money doing it, you can't do it with massive money. And it's so much simpler to just acquire great companies. So now I'd instead buy a great company at a fair price than just a fair company at a great price. But I have an old-fashioned idea that I should only expect to make money and accomplish things that I understand, and by understanding, I don't mean knowing what the product does or anything similar. I mean understand what the company's economics are going to look like 10, 15 years from now. In general, I know what the economics will say about Wrigley chewing gum in the next 15 years. The internet will not affect the way people chew gum, nor will it change the gum people chew. If you possess a large portion of the chewing gum industry, and the chewing gums most probably will still be available in 15 years. So I can't predict precisely what the statistics will look like for Wrigley, but I won't be far off if I try. Evaluating that firm is inside what I called circle of competence. I understand what they do, I understand the principle of it, and I understand the competitive elements of the company. But the worst mistakes I have done by far are mistakes of omissions, but not commissions. It's the stuff I knew enough to do. They were all within my circle of competence, and I was playing dumb. And those are the ones that really hurt. They don't appear anywhere. For example, I definitely cost Berkshire Hathaway at least $5 billion. I don't care if it's Microsoft. I don't know it since Microsoft isn't even in my circle of competence. And therefore, I have no reason to assume I'm able to earn money from Microsoft or cocoa beans or whatever. But I did know enough about Fannie Mae to blow it. And it never shows up in conventional accounting, but I know the cost. I missed it entirely, and those are my biggest mistakes. And now I've had plenty of them, and you won't know it unless I show it in the annual report. And I avoid the urge sometimes. You won't know that it doesn't show up under conventional counting, but omission is far greater than commission. There are many possibilities in life that must be taken advantage of. We don't do a lot of things, but when we have the opportunity to do something right and big, we have to grab it. And doing it on a little scale is almost as bad as not doing it at all. I mean, you really have to grab it as they come, as you aren't going to get 500 wonderful opportunities after you finish your studies. Let me know in the comments if you have any other questions about investing. Let's return to the video. You were given a punch card with 20 punches on it, and each financial decision you made cost you a punch. You became very wealthy because you worked very hard. Each of you went to a cocktail party and someone mentioned a company. He had no idea what they were doing or couldn't pronounce the company name, and yet they earned a few dollars last week, and one like that, you don't bother buying it because you only had 20 punches on that card. In terms of our totally owned businesses, we're never going to sell them no matter how much someone offers us. I mean, if someone offers us 3 times the value of something, whether it's candy, the Buffalo News Board, or whatsoever, we're never going to sell it. I may be wrong about that strategy, but I know I wouldn't be incorrect if I owned 100% of Berkshire, since it's how I want to spend my life and I had all the money I could possibly need. It all comes down to a change in the newspaper report about my obituaries and the amount of money the company has, as well as the breakup of relationships with individuals I trust and those who have joined me because they believe it is a permanent home to do. That merely because someone throws a huge check at me is similar to selling one of my children, since I'll be waiting for a big check, so I won't be doing it. And I'd like to warn my partners I won't do it, therefore they don't disappoint me. We're seeing that strategy more and more with certain stocks. If we were severely short of funds and had a lot of opportunities, we might try a different strategy. But our inclination is never to sell things unless we become extremely dissatisfied with the management or believe the economic characteristics of the company have changed significantly, which they do. So we aren't going to sell it because the price appears to be too high. How do you identify a company's intrinsic value? The intrinsic value is the sum of all the cash that a company would offer you between now and Judgment Day if you knew everything about the future. Discounted at the appropriate rates, that figure represents the intrinsic value of a company. In other words, the sole purpose for making an investment and putting out money now is to receive more money afterwards, right? That is the essence of investing. If you check out a bond now, assuming it's the US government, it's easy to predict what you'll get back. It states right on the bond that when you will receive the interest payments, when you will receive the principal, if interest rates fluctuate, although your cash flows are written on the bond is worthless. A stock certificate does not include the cash flows. That is the analyst's job to print out, convert that stock certificate, which represents an investment in the company, into a bond and say, this is what I think it will pay out in the future. If you purchase Coca-Cola now, the company is worth around $110 to $150 billion in the market. The issue is, would you pay that much today to acquire the Coca-Cola company that can pay you over the next 1 to 2 centuries? As you move further out, the discount rate will not really make much of a difference, but the point is how much cash they're going to offer you. This isn't about the number of analysts who will endorse it, how much volume is in the stock, how the chart looks, or anything else. The sole reason is to see how much money you can get out of it. If you're looking to buy a farm, this is true. If you're looking to buy an apartment, this is true. Any financial asset, oil in the ground, you're putting money down now to receive more money back later. And the question is, how much will you get? When will you get it? And how certain are you? And when I assess the intrinsic value of a company when we purchase companies, whether we're buying the whole company or just a portion of it, I always assume we're buying the whole company because that's how I think about it. When I look at it and ask myself, what's special with this company and when will it pay me? What you actually want is for them to be able to spend the money they make and earn bigger returns on it as time goes on. Berkshire has never paid a dividend to its stockholders, but its potential to do so is to grow the value of the companies we own. We can grow it internally, but the main question is whether Berkshire will sell for, say, $105 billion. What can we offer? If you're going to purchase the entire company for $105 billion today, can we pay out enough cash to you quickly enough to make it worthwhile at current interest rates to put down that cash now? That's what it comes down to. But if you can't solve that issue, you can't buy the stock. You can take a risk in the stock if you want, or your neighbors can purchase it. But if you can't solve that issue, and I can't handle internet companies, and there's a lot of companies, all types of companies, I simply stay away from those. Hope you have learned something from this video. What are your thoughts? Comment down below. If you enjoyed this video, make sure to click the like button, and also don't forget to subscribe to the channel and hit the notification bell for you to be updated on our latest videos. See you in the next video. Thanks for watching. Want to learn more and be more financially literate? Click on the next videos we have in our channel, showing on the screen right now.